So I started working in the world of equity compensation long before most people in this industry were alive.
Right.
So I got into the industry in 94.
So you were there right as equity was becoming broader and it wasn't just for VPs anymore and it started pushing its way down.
Yeah, I was there
Okay.
when people still were talking about things like how do you do a same day sale?
Right.
What is that? What is an incentive stock option? And did you know the rules changed on incentive stock options? Now people can exercise them in any order they wanted. So when incentive stock options first became a thing, and until the late 1980s, you had to exercise them first in, first out, regardless of the grant price. So even if you got new lower priced options, you couldn't exercise those until you exercised all your older options. Also, you know, I was working with companies that still had legacy programs that had 25-year lives on their non-qualified stock options. It was not uncommon,
Hmm. Hmm.
which today you tell somebody a 25-year life on an option, like, how could that even exist? That's not
Right.
possible. It's like,
Yeah.
actually, still totally possible. You can grant a non-qual still today with a 25-year life.
Yeah. Yeah.
Um, but there's so many things that have changed over the decades and so many things that haven't. It's really fundamentally disturbing at times to me that, I posted I saw this thing, somebody posted a list of the top 9 IPOs expected to happen in 2026. And like they've traditionally done, they listed those IPOs in terms of millions of dollars of potential value. The top of that list, so put this in perspective before I give you these numbers. Um, in 2000, 25 years ago, let's say 2001, a really good IPO was a $500 million IPO. That was an impressive IPO. And you might have 500 or 800 employees when you went public. So they would list that your value was $500 million. That was your potential IPO value. And then, big IPOs happened and you saw Snowflake. Now, what is it? 6 years ago? 2020? Something like that. Snowflake went public at $40 billion, which is astounding. A number that's hard to comprehend until you look at the list of the potential top 9 IPOs for 2026. In number 9 is a company called Proofpoint with a potential value of $20,000 million. That's literally what's listed on the chart. $20,000 million.
That's number 9.
That's number 9.
Okay.
20,000 million or $20 billion. 20,000 million. 20,000 million, which seems like just a really impressive number until you look at number 1, which is OpenAI. And OpenAI's value is $500,000 million.
So 500 billion.
$100,000 million, or $500 billion for an IPO value.
For a
Now, I'm
software
not here to
company.
say whether that's a good value or a bad value or a right value or not right value. It doesn't make any difference. But equity compensation programs fundamentally were not designed with the concept of IPOs at $500 billion.
Mhm. Mhm. So why does that impact it? So why does these high valuations change the nature of how equity can or should be used?
Well, one of the things that hasn't changed is for most organizations, 10% of their equity pool, or 50% of their equity pool, so 10% of the company, has been allocated within the first 50 to 100 employees at a company, which when you were going public with 500 employees and the first 20% of them got half of the total equity, you're like, okay, I can see that. They took a big risk. It's harder when people are the first 100 employees at a company that's worth $500,000 million or even $20,000 million, because at that point, equity is not about motivating people to become owners and grow a company. It's
Mm-mm.
about creating future hedge fund uh, startups. It's about people going, well, when I leave this job in 7 years, I will be internationally wealthy at a level that I could literally disappear.
So it's really wealth creation is what it's kind of coming
It's
down to, right? It's
beyond
not.
wealth creation.
Yeah, yeah.
It's a level, you never heard the term related to compensation, um, generational wealth
Hmm.
until about 5 years ago.
Yeah, generational wealth is something you got if you started your own business, right? And yeah, to get
Or
generational
or
wealth,
when you were like, the grandson of, a Rockefeller.
right? Yeah, but not as
It's
an
like,
employee of a company,
yeah, it's generally not when you were the fifth software engineer to join a company. That person didn't get generational wealth. And I don't have any problem with people making a lot of money. What I do have a problem with is that we didn't adjust how we do equity. Um, and people have tried recently. I'm not going to name any company names as far as in the compensation world. But there are companies now that are saying, well, what you have to do is use the value at the time of grant. Don't use percentages. Use a value at the time of grant. But the value at the time of grant is based on one of two incredibly fake numbers.
right?
It's either based on a
Either
401A
409A
value,
or
which
it's a
is insane, that they're just sandbagged, ridiculous numbers. They don't represent anything other than a starting point, or they're based on a preferred stock number. Also insane, because if you're getting options in common stock, you don't have any of the privileges of a preferred stockholder.
right. Yeah, and just like
So,
just for anyone listening, where does that preferred number? I think there's a lot of confusion around what that is, and a lot of the times it's seen as a proxy for the value of the company. But just talk us through what the preferred price is.
yeah, so the preferred price is the price that an investor values the company at because they get preferential treatment. It's not just the stock has a different name. They get preferential treatment in the form of liquidation rules, in the form of carrying forward in the case that the company is acquired, in the case that a company goes public early, in the case that the company doesn't hit a certain valuation or is hits above a certain valuation. So they can look and go, look, I'm guaranteed that I'm not going to be diluted beyond a certain amount. I'm guaranteed that if the value is this much, I get this percentage of that value. So I'm buying in knowing I have far less risk and far less time frame risk than an option holder. So an option holder is going to get stock options, or an RSU holder is going to get RSUs that, first of all, are subject to some kind of time. And if you don't make that time, you don't get the option. You don't get the RSU. And then the company has to increase in value. And then the company has to increase enough in value that the people at the top of that stack, the people with preferred treatment, get their money, and then you get your money, which in many cases, not a big deal. In other cases, at a company a couple of years ago I worked with, that when we looked at their waterfall stack, the organization was confused because they had granted options that they claimed were worth $17 and change a share. And we looked and I went, well, based on your waterfall stack at a $3 billion valuation, what you're claiming you're going to go public for, your common stock is worth negative 74 cents a share. Because after you pay off everybody at the top, the debt holders, the preferred stockholders, the warrant holders, everybody else that's in front of you,
Right.
by the time you get to the front of the line, the stadium is sold out. There are
Right.
no seats left.
Hence the term preferred, right? That's where it comes from.
That's the
um,
concept. You get to go in first. It's when you go to Disneyland and you buy one of those super passes that allows you to the front of every line. Nobody likes you. I mean, you like you because you get to all the rides first. It's when you go to the Super Bowl and you buy a skybox and you get served great food. You don't sit up in the, rarefied air and can't see what's happening on the field. The same is true with shareholders. And again, it's just a reality. I'm not saying that needs to change. I'm saying that we haven't adjusted equity for that reality. If the potential value of your organization is $500 million, perhaps the people at the front of that line getting equity as employees should get smaller equity amounts so that they're a term that I've used regularly that nobody uses, what we refer to as the future potential realizable value. So that's calculating based on your current value and based on scenarios of future values, what your equity can possibly be worth. And you look and go, even the CEO, you look and go, okay, so your equity could be worth $700 million. Is that enough? Is that enough? Do you have enough equity? Do you need more equity to give you more money? Or, hey, you as an engineer, you're paid $240,000 a year. And the equity that was granted to you in your initial grant is worth $11 million. And I'm going to give you, because I have a process, a formula, I'm going to give you a refresh grant at 3 years worth 25% of the number of shares you got in your first grant. And that refresh grant, which is going to eat away shares that I could give to somebody else, is going to add to your $11 million, potentially $78,000. Do you care?
And I think whether you care or not, we come back to the question, why do companies use equity? We talk about these big numbers and we talk about it's a great form of individual wealth creation. But what problem are companies trying to solve when they do equity? And I actually want to come back to that because I do want to come back to two terms that we've used and clarify a couple of things for anyone listening because a lot of people get lost in equity and terminology and things. So we talked about a preferred share, what it is, why it's called a preferred share. One question, I've got two questions on this. One question is, who decides what that value is?
So you would like to believe that some kind of market sets that price or that the company sets that price. But the investors set that price. More often than not, the investors come in and go, we think you're worth this. And therefore, we're going to pay you this much money and you have to give us this in return. We have to have a seat on your board, maybe two. We need to be able to control who you hire at C-suite and above. We are going to control their pay. We are going to control your operations. We are going to control your head count. We are going to get paid out if this, and this happen in advance. And for the money we're giving you, we're going to get preferential treatment with all of that involved. So we have risk, but the risk is much lower than the begrudgingly 15% pool we're allowing you to grant the other hundreds and or thousands of people
Right.
that are going to work at your company to make us our money.
So they're essentially bidding for the rights to have that say in how a company is managed. So as we're thinking about, okay, we're predominantly thinking about private companies here, and we're thinking about the preferred price. So my question is, as external investors who obviously want control of the company in exchange for that investment, do they have an incentive to move that share price up, down, or nowhere? What is that? What is in their best interest for that preferred price to be?
Um, it really depends on their ownership and dilution more than anything else. So there is an argument that having a lower price is a good idea. And the lower price means they're spending less to get the ownership. Um, but in today's valuations, early stage, it's actually better a lot of times to have a higher price up front for an investor to provide their own credibility that the value of the company is worth more. If you're an early stage company, you will find it's very difficult to get investments in a company that's worth 5 million or $10 million. It's much easier to get investments in a company that could be worth $100 million. And it's much easier to get investments in a company that's worth $100 million if you say, well, it really should be worth $1 billion. And it's much easier to get an investment in a company worth $1 billion if you say it could be worth $20 billion.
Mhm.
So to then sandbag as an investor the value and then convince everybody else, but it's worth a lot more than that can be difficult. They're like, well, if it was worth a lot more, why didn't you pay a lot more?
Right.
Well, it wasn't worth a lot more until we came in, is a very difficult argument when it's a bunch of people who all know each other and they're all equally rich and they're all equally making similar um, investments. So
It's fairly political, that preferred price. It doesn't really reflect a market valuation, like you said to begin with. It reflects a political agreement on what that number should be.
right. And again, that used to be something that was exclusive to private companies. There
Right.
are rules in the legal world called blue sky rules. Blue sky rules are the rules that in 41 out of, I think, 50 of the states now, the blue sky rules match SEC rules on disclosures. Um, but a blue sky rule was put in place after the Great Depression and crash of the stock market to stop people from promising that the sky would always be blue if you bought their company's stock. That's literally why they're called blue sky rules. Um, but you could still get away with it in the private world because you don't have to do all the filings. You don't have to prove that your revenue is what you claim your revenue is. You don't have to prove that you have the clients that you say you have. You don't have to prove that your software works the way you claim it does. People just have to believe you. Now,
Mhm.
there are always exceptions to that rules. Theranos, however you want to pronounce that company's name, and multiple others since then, where, hey, it turns out we don't do any of the things we claim we do. There's actual fraud and people went to jail. And a lot of industries, that's been the case. But more often than not, it's on the investors to be smart enough, to be sophisticated enough, to be educated enough, to have done enough research to make smart investments. Because they're not designed for a regular schmo to buy into a private company stock. The only way you can buy into those private company stock prices is via stock options or RSUs, some kind of thing the company gives you. It allows you to get around those rules. And those rules, again, going into technical issues, Rule 701, which was a rule that said, hey, look, only 500 people can get this kind of stuff. And then in 2000s, early-ish 2000s, that got moved up to 1,000 investors can get this exemption from Rule 144, which is a disclosure rule. All of this stuff, though, is to protect people who don't know any better from not knowing any better. It's like, hey, look, we want to protect you from yourselves. But this sort of cult of what a company is worth now exists in public companies. You saw it with, the meme stocks,
Right.
GameStop, arguably. And again, I hate saying this out loud because somebody's going to get mad at me. Um, Tesla is arguably a meme stock,
Hmm.
right? We're going to make somewhere between, and this was a quote, hundreds of millions to billions of autonomous humanoid robots. The difference between hundreds of millions and billions is a lot. That's like saying that the, price range for this job, market pricing is 100,000 to $1 million in base pay. That's not a range. That's just a random number that's above, minimum wage. So I think there's this craziness that's even happening in the market itself right now
Hmm.
that used to only happen in private company stock.
Yeah.
And that's why companies stayed private. And it's why companies went to becoming private. When a lot of these companies went private, it was because they were tired of having to disclose all the things that showed that their value shouldn't be as much as people thought it was.
Yeah. Yeah.
Like, what if I just don't tell you anymore?
Right. Yeah. There's a lot of requirements that come with being a public company that create headaches, right? For those
Right.
companies. Yeah.
Now, the flip side is the number of people that just ignore that information
Mm.
seemingly is more than it has ever been.
Right.
I don't really care what the disclosures are. I don't care what the numbers are. I don't care what the CFO said. I don't care what the data says. I still think the company's worth a billion, zillion, trillion, gabillion dollars. And you're like, that's not even a number. Yeah, well, I didn't believe that those things, and I don't believe in the things you call numbers. I'm just going to pick up a number.
And if enough
But
people believe that, then that becomes the value.
yes, it's an
That's how it
emperor's new
works.
clothes syndrome, and we saw it happen in the past with the finance uh, industry when, you know, in 2008, 2009, everything collapsed and people were like, wait, so how could you be worth this much money if all of it's based on this weird pyramid scheme accounting? Well, because we say it is until it isn't.
Until it isn't, right?
Um,
Um,
and that's the risk of working at a private company. So all of this coming back to equity is if we believe the 20,000 million number, the 500,000 million number, these billions and billions of potential value at IPO, we believe that's going to become a real measuring point. So if 20,000 billion is the ninth best IPO, then is 1,000 million like a typical IPO? Is the typical IPO $1 billion? Well, if you look, the typical IPO is actually about $1,500 million. It is more than $1 billion. And you go, okay, well, if it's $1.5 billion to $2 billion for an IPO, is the process that we've used for 30-ish years to determine how much equity people get, is it designed for multiple $1 billion valuations, even taking out OpenAI or even the top 10? You say, okay, great, the exceptions that prove the rule, get them out of there. Okay. But even then, nobody adjusted any of these things. If you look at, and Radford is considered to be one of the best standards for technology and startup market data, and has been for a very, very long time, since before it was Radford's data. I remember when Quantic existed. So it's been a long time.
I've heard
But the
reference to that
data,
one.
the data has not fundamentally changed.
When you
It's
say the
still about
data,
20%.
Yeah.
The amount of equity a software engineer gets as a percentage of ownership, according to the surveys, is about the same.
And now we're talking about VC backed, mostly private companies at this point, right?
VC-backed
And
private
yeah. Okay.
companies. So
Yeah.
these numbers in the early and mid stage IPO process are about the same as they've been 20 years. And you look at that and you go, yeah, but if the companies were worth $250 million when they went public in those days, and they're worth $2 billion, $2.5 billion now, did we intend to give that software engineer 10 times as much value?
Yeah. And I think that's why a lot of companies are shifting towards value based approaches, right? Because the percentages just defy logical expectations as to what a human should receive in exchange for their job, which is part of the
Right.
problem with that percentage.
Well, it's not a job anymore. It's
Yeah.
not compensation. It's something
No,
else.
it's
It's not,
something else. Yeah.
but
Yeah.
that's, so
Well,
if
before
it's
we get
not,
into that, then actually, can I just one thing
yeah,
before we move on? Is I do want to
yeah.
get into that discussion. We talked about a preferred price, and again, just for the benefit of anyone listening who's new to this, and a lot of people get confused by it, the 409A price we mentioned earlier, the 409A that applies to private companies, is the other key number in the equation of figuring out how much stock options are worth. Talk us through that. What is it? Where does that come from?
So the 409A value can be done in three different ways. 409A value can either be in some industries, it is the standard methodology for figuring out the value of a company. It's the easiest way to do it, and it's the organizations that are the least likely to use equity compensation, to be honest with you. So, professional services firms. When you're buying people, which is a professional services firm, if you get 2 times revenue, that is an amazing number. It's an amazing number. Very few companies get more than, 1.5 times revenue, even 1.2 times revenue. And that's because it's something where you have to constantly be reselling. People have to close new business. It's relationship based. And so, but restaurants, the same thing. You look at what a restaurant makes, what it turns over per. There's a basic formula for restaurant valuations. You go,
And these
okay,
are these are
formula.
accountants, right, that do this. These are
Yeah,
accountants who look at the industry, look at the company, look at the revenue. Okay, then all things being equal, this
yeah.
is probably what it's worth. Okay.
Based on how many tables you have and how many people you have and how quickly you turn the tables and how many meals you sell,
Mhm.
your valuation is this. Done and done. Formula. Another way to do it is to have a formulaic method that works for your company that you've defined because you have somebody internally that's amazing at valuations, which immediately throws out 99.9% of companies. Because the reality is almost nobody has an internal person that's great at valuations. And when they do, those people absolutely don't want to be held accountable for that valuation number. So they're like, yeah, I can do valuations, but I'm not doing our valuation. So the last method is to have an outside expert figure out the valuation. So let's take a step back. What is 409A at all? 409A is a rule that was rolled out after some companies, Enron, WorldCom, and the like, bent rules. And the government came back and said, hey, you know what? We don't think you're actually valuing things correctly. You're just licking your finger, putting it in the wind, and saying this is what your price is. And so people go, yeah, but what if we had a formula to lick our finger and put it into the wind? What if somebody else licked their finger and put it into the wind? And that's what 409A values became.
So
The
it came as a
comical part of
response, like so many of these things. It was a response to poor company practice, essentially. Companies trying
it
to,
was a
uh,
response to poor company practices and poor governmental regulations. Sort of like 162M, the $1 million cap on people's pay. No, that's just became bottom threshold for people's pay. Well, if we pay people $1 million without paying taxes, we should pay them $1 million. Um, so 409A became this thing that is supposed to represent your future value, taking into account risks and other pieces. But it really was a way to sandbag your value. So you have a starting point the IRS is fine with. Everybody feels comfortable that there's a starting point. You can't grant less than that value.
So when you say you can't grant that, so what you're saying is you can't set your strike price of a stock option, or you can't award it the stock, otherwise it becomes a taxable benefit, right? And you have to start, and it gets
Right.
complicated.
Because that's the minimum price. Anything below that price, then there's tax consequences.
So if I want to give you stock, I get a 4 that says it's $10. I can't now give it to you for $2 as a thank
Well,
you. That
I could, but if I gave it to you at $2, then there's income tax consequences
right,
and
yeah,
on both sides of that. So if
and
people go, oh,
almost
you know what,
no
I'm just going to,
company, yeah,
yeah,
no companies really get into that, right? But at least most of the companies that we're thinking about now, they'll generally observe and respect that 4 and they'll set their award values at that
yeah,
price.
that's our price. But the
Okay,
price is always way lower. And the way you know this is true is when you say, well, okay, so your 409A value sets your company's value at $150 million. And CEO goes, yep. And you sit down with the CEO on the board and go, so if somebody was going to acquire you, just give you cash money, what would the company be worth? What would you take? $1 billion. You just said the company is worth $150 million, but you wouldn't sell it for less than $1 billion. Yeah. And 409A is supposed to represent your future, your forward looking value. Yes. So your company isn't worth 150 million. No, no, no. It's definitely worth $150 million.
right,
Okay. So again, if somebody was going to acquire half of your company, they could do that for $75 million. No, half my company they could acquire $500 million. So your company's worth $1 billion. No, it's worth $150 million. I'm like, no, it's catch 22.
yeah, and this is
Uh,
the tension between that preferred price and the 4 The likely valuation is probably somewhere between those two, right?
well, it's not even the current preferred price. It's the preferred price for the
Right.
next investment.
Yeah, yeah.
So your
That's
preferred price might be at 10 at 20. Your 409A value might be at 750. But if somebody goes, well, I want to buy in, you go $22. Wait, what? I thought you said, yeah, well, actually, now that a lot of people want it, $34.
right. So, and this
Wait,
is
but I
where the
thought you said it's worth
confusion,
750. Yeah,
right?
well, not to you.
But to employees, so how do employees make sense of this? Because they're often presented with these numbers, right? And they
Well,
said, and they get told that we're going to IPO for this, that, and so, but the strike price is that, and that's the valuation. But you said it was worth this, and now you're saying, and
well,
that's
that's
where
the
a lot of
change.
this, yeah,
Is then
right,
they come back and companies go, okay, because over the years, people have now decided 409A is a reasonable valuation to explain to their employees. So here's what your equity is worth. It's worth your number of options at the 409A value. Okay, first of all, no, it's not because I have to pay you the 409A value.
right. So that's zero, right? So at the time I grant that to you, it's worth nothing in
It's worth
theory because I need to,
$0.
right? Yeah,
And then there is the time risk and there is the employment risk. So it's not just worth $0, it's way less than $0. So then you have to provide what is the upside potential value. And if your upside potential value outweighs the downside risk, then your equity has money into it. The problem is that's complicated
hmm
and it's subjective. Um, and everybody wants to make one side too high and one side too low, and they just go, trust us. Um, with the concept that equity is designed as a future ATM machine.
Mm. Okay.
So
So
let's
now we
get
get
down
to the point.
into the intention of equity.
So now we
Is
come
it
back to
does
the question. This is going to be the crux of our conversation. What is the point of equity? Again, you mentioned this. You've been around since equity was kind of pre. So I'm not trying to make you seem older, by the way. So,
I'm
but
old.
you've been, but you were there when equity was really reserved for executive and VPs and all that kind of stuff, and you've seen it shift to be more of a wealth transfer. Well, I don't want to put words in your mouth, but what is equity? Like, why do we use it? I mean, whether it's in a private company or a public company, what's the point of equity?
When equity was rolled out as a concept and a tool, there was a bunch of people at Fairchild. They were competing against IBM. IBM paid good money, and no matter how big IBM got, that's what you got. You got your money. And some people said, hey, we're going to start this new company, but it's risky. You're not going to be able to get paid what IBM pays you. That's insane. We don't have that kind of money. We don't even have any customers.
And at the time, IBM was like the place to be, right? I mean, IBM was like one of the world,
IBM was, imagine Microsoft, Apple, Google,
right?
and Nvidia all in one company.
Right. Global
That was
standard for what a tech company should be. Like it was
yes.
king of the world. Yeah.
In the early 70s, late 60s, IBM, if you got a job in the tech world, you were working IBM or you worked someplace crappy. No, that's not, it's an overstatement, but that's really kind of
Right.
what it was.
Yeah. That was the gold standard. Yeah.
And, and if you got a job at IBM, it would be a job for life that you got paid good money for. You could live fine,
Yeah. And the
upper
reputation,
middle
everything.
class,
Yeah. Yeah. So
upper middle
Fairchild looked
class
at
the
that.
rest of your life.
And so Fairchild looked at that. So we want the quality of people that IBM are getting, but we can't pay what IBM made because we just don't have the
It's not just we want the quality of people. We literally want to hire you away from IBM. They were literally a mile and a half from each other in
right.
certain places. We're
Yeah.
going to open up an office. Just don't drive over there, drive over here.
So
We're
they
going
were
to
doing
pay you
everything to try and
75% of what IBM pays you. But we're going to give you this thing called a stock option that gives you the ability to buy into being an owner of the company as if you invested today, but you don't have any money to invest today. We got that. So we're going to give you this. Again, a stock option is an option to purchase stock of the company. It's an option over common stock. And in fact, in most other countries, that's how they refer to it. So it's an option to buy the company's stock at some point in the future as if you were buying it today. That's the concept. And so we want you to be an owner, but we get the fact that you need to save up some money. We're going to pay you so you can do your job, save up your money for the next 4 or 5 years, and then buy in like you're one of us, one of the owners.
And by the way, was Fairchild public or private at the time they were doing this?
They were privately held.
Okay, so this was an option to buy into a company that otherwise there was no other way to be an owner of this company, basically at that
Yep.
point, really, other than
Intel did the
becoming an
same
employee.
thing.
Okay,
Intel looked at Fairchild and went, we're going to do the same thing. You can look at their proxy. It's you can still find it on Google. Their 1971 proxies from Intel to look at how much equity they've given and how much. It's pretty interesting information if you're a geek.
yeah, which I am. So yeah, that's interesting.
Yeah.
And
So it's
also
out there.
at the time as well, was IBM offering stock to its employees at the time also?
No,
So
why would
they were reserving stock for their upper echelons, I assume, at that point.
not
So
even very much to their upper echelons.
okay, so this is a
So
time in the world where even execs weren't really getting equity in the valley in tech. This is a very
yeah.
different.
So
Yeah.
so one of the first companies in the Bay Area to do this really, not even broadly, but bigger was
Mm,
Andal.
mm, okay,
In the early 80s, late 70s, they started granting equity to about 1,000 people of their 12,000-ish employees.
okay,
But that was wild
yeah.
because it used to be that these were only granted to people in the top 20. And Andal's giving it to thousands
So it's
of
actually
people.
getting down to people doing the work, like people who are getting a job that they're not execs, they're not sitting in boardrooms, are actually doing the work, building the value of the company, and in theory, being rewarded by a piece of that company in the future.
Yeah, I still and again, the concepts of things like employee stock purchase plans that
Hmm.
were available for public companies didn't even exist. I actually have one of the very first presentations ever printed on paper on by an attorney named Renee Deming, who's still out there, and an attorney named Tim Sparks, who was one of the founders at Compensia. Um, Printed on red paper, black ink on red paper, because that's how you made things look fancy in those days. It's a little before my time, but not dramatically. It's like kids' construction paper almost. Talking about this concept of an employee stock purchase plan that you could broadly offer to people, because you would never give ISOs or non-quals broadly to people. That was insane. But this presentation was from 1990.
Yeah. And
It's
so at
still
this point, I assume most companies were not doing ESPP. ESPPs,
They
of
didn't
course,
have an ESPP.
right.
There was
Yeah.
no
So that,
such thing. Some
yeah.
people at Cooley and Wilson Sonsini like went back and forth and said, oh, there's this section in IRC 423, which, by the way, specifically defines a type of stock option.
Hmm.
There
Mm.
is no such thing called a stock purchase plan.
Stock option plan.
It's a stock option
Yeah.
plan that allows you to pay the exercise price by taking deductions out of people's pay.
Yeah. Did it have a discount at that point as well? We all know there's a sort of 20% maximum discount that you can offer employees in exchange for that. Was that any of that in place, or did that come
The
later?
15% off the beginning, 15% off the end, all of that was defined
Okay.
in 423. So 423 is part of the same section of the IRS code that defines incentive stock options: 420, 421, 422, 423, and 424.
Hmm.
Those sections of the IRS code. And they've changed very, very little in 40 years.
Yeah. Okay.
Very little. There's not a lot to them. You can actually read section 423 and 423B in 20 minutes.
Right. So they're basically the same. And so if we go back to our Fairchild versus IBM scenario, and this is in the
Right.
late 80s, early 90s, right? So Fairchild were using equity as a differentiating component of rewards to attract and get hold of the talent that they didn't feel they could do under conventional models.
And to offset the fact that they couldn't pay people cash
Right. It was
in
in
the
lieu of
up.
cash. Yeah.
So the deal people made when they joined a startup from 1970 through, honestly, the end of the 80s, that 20-year period, the deal was you're going to get worse base pay. You might not even get 25th percentile base pay. But in return, you're going to get this thing that could be worth 10 times your base pay.
Right. Could be. And at that point, no one had any reason to doubt it, right? At that point,
Right.
there wasn't enough.
Maybe 10 times. So you
Yeah.
could, I, so again, it's hard to understand even how pay works. I had somebody years and years and years ago. It was 1996. Called up, was screaming that he did not want to pay $4 million in taxes. I went, just take a deep breath. He worked at a company in Massachusetts that was in the silicon uh, manufacturing space. And I said, you're a software engineer, right? He goes, yeah. And I went, so what do you make? $85,000, $90,000 a year, which, by the way, in that time, that's how much a software engineer made.
Yeah.
$85,000, $90,000 a year. It was good money, but it wasn't.
I was going to say that was pretty good money in those days. Yeah.
And he goes, yeah. And I went, that's why $4 million sounds like a lot of money to you. He goes, yeah. And I went, let me put it this way. You're going to get almost $8 million without taxes. He goes, what? I went, your total value is $12 million. You're going to pay about $4 million in taxes, which means you're getting $8 million, basically a lottery ticket, tax-free.
And this is someone that had $12 million worth of paper value and didn't really understand.
Didn't know it at all.
Didn't get it. And it has things changed at all? So, like, I mean, I think there's a better understanding now, right? But there's still a lot of that confusion.
Among some, there's a better understanding. But the flip side is most people now think that all their options are worth $1 million.
Hmm.
Well,
Well,
I'm going
do
to be
they?
a millionaire.
Yeah,
I'm going
but
to be
do
a
they
millionaire.
still believe
Everyone's
that?
going to be a millionaire. Everyone's going to be a millionaire. You're like, you have 3,000 shares at $17 a share in a company that might go public at $20 a share.
Right. Yeah.
1,000 times $3 is not $1 million.
Right. But
What's it
think now,
worth?
but Dan, do people still believe this though? Because the odds of a VC-backed company going public, I believe, are somewhere in the region of about 1 in 20, depending on what data source you look at. So the odds of
But
an
everybody thinks they're the
IPO,
one.
everyone thinks, but do they think they're the one? Because I know a lot of founders think they're the one, but I increasingly feel like I hear that the employees don't care, and they also don't believe that it's worth that much. It's not as useful as a recruitment tool.
Well, I think what I've found is everyone thinks the day they get their grant, everyone thinks they're the one. And then they get a year into the process and they go, So what's this worth? Well, we still don't have any idea.
And they've
And
also
by the
had
way,
a
this
chance to look
place seems
around.
like true chaos.
Yeah.
And how are we even going to survive? We seem like we're going out of business every day. I'm just going to go get a job somewhere else that also is going to promise me that I'm going to become a millionaire. Because I only got 50,000 shares from this company, but that one over there said they're going to give me 200,000 stock options. You're
So
like,
now we get into the question that initiated this entire discussion, which is, does equity retain people? So is it a retentive vehicle? We hear it a lot about this, and unvested equity means that people are more likely to stay, particularly with execs. Execs are special, obviously, so we need execs to have lots and lots of equity unvested, otherwise they're going to leave. Should we think of equity as a retention mechanism?
correctly designed and communicated, it is an excellent retention tool. And the answer to the question, is it a retention tool? No,
Right.
because it's almost never correctly designed or communicated.
Even if it's correctly designed and communicated, wouldn't I just go somewhere else and get more equity?
Not if you got it at the right time and it was
Hmm.
correctly designed and communicated. If you're getting equity in a company 8 months before it goes public,
Hmm. Doesn't matter.
unless they're really trying to game the system with their 409A value, which is hard to do, because if I do a graph like this is sort of what the graph of stock prices look like from a preferred standpoint. It goes $10, and then it goes $20, then it goes $30, then it goes $50. The 409A value goes $1, $1.15, $3, $6, $50. You're
Yeah,
like, wait,
yeah,
what?
yeah. So as an employee, you're trying to catch it before that hockey stick, right? You're
Right.
trying to get in
Somewhere
there. Yeah.
between the 6 and the 50 is when the SEC starts going, hey, you can't game your price anymore. You actually have to start ramping up for the potential IPO value.
Hmm.
So
So
you
really,
can't worth nothing.
so you're saying if you were in there early and you are part of the mission and you got in an early price and you're now sitting on a large amount of value that you will lose if you leave the company, then it does become a retention mechanism
It
because
can't be if you understand it.
if
But
you
most
understand and
people
you believe
don't
in it.
understand it. They
Mhm.
don't understand that the shares you got in this early stage company that are now 3 years into a 4 or 5 year vesting schedule that are going to be fully tradable in 18 months when the company, or 6 months when the company goes public, that all of those are arguably irreplaceable at any other company unless you're willing to wait a similarly long time and go
Right.
a similar ramp.
Yeah.
People go, well, people right now, I'm going to go work at OpenAI. They're going to be worth $500,000 million. Yes, they are. By the way, you're not going to be worth $500,000 million. You're joining very late into the game. It's not that they're not worth anything. It's sort of like getting a SpaceX equity award right now. It's a great thing,
But you're late to the game.
but
Yeah.
it's not like getting a SpaceX award 10 years ago.
Which
Those
I
people
kind of
are
want to
doing
come
pretty
back
well.
to your Fairchild IBM example. One thing that Fairchild was doing, in addition to making up for the lack of cash that they're offering, is they were offering meaningful ownership at the time, right? So you actually did become an owner of the company. And if we go back to what we were talking about earlier around VCs and the preferred price and all the power that they want in exchange for that early investment, one of the problems I think is that you're not really an owner when you get that equity. You're sharing the increased value, and if you get in early enough, you'll get a lot of that value. But you don't really get a say in how the company's run. It doesn't really foster that ownership mentality. If all the employees in most VC-backed companies got together and wanted to do something, they would still basically be powerless to their investors, who ultimately call the shots. So is that I guess my question really is that is that part of the problem? Then it doesn't really, although equity is a form of ownership, it's not really fostering the same ownership mentality as maybe it once did when employees really did become the owners of the company.
Well, so it's kind of a myth.
Hmm.
Um, in those days, people felt like they had a lot more power over the company. And to some extent, It's certainly more than they have now, but it was never as much as anybody wanted them to believe it did. It more had to do with whether management cared about their employees' opinions. Um, because if you go back and look at Fairchild and Intel, it wasn't like they were granting 50% of the company
Right.
to
It
the
was still
executive.
minority owners. The employees were still
Wild
minority. Right.
minority.
Okay.
Very few companies got above 30%. And I'm sorry, 30% is less than the rest of the percent.
Hmm.
So your
Yeah.
employees still are simply adding to. So oftentimes that what it was, hey, look, our executives own 30% and our employees own 24%. So if our executives and our employees get together, they can outvote our
Mm.
outside shareholders.
Yeah.
And that can still happen. But more often than not, it's our executives hold 14%, our employees hold 15%. So they could all get together and whine
But they
because there's
ultimately,
nothing they could do about it.
there's nothing I can do. Yeah.
Yeah, if the shareholders, if the major investors want to sell your company, destroy your company, make fun of your company, it doesn't make any difference. You can't do anything necessarily with that. And this is where you see a huge differential between ESOP companies, and ESOP is an employee stock ownership plan
Hmm.
company, where true ownership is in the hands of employees through a trust, and employee equity companies that use options and RSUs is the employee stock ownership plan companies offer real ownership, also offer much more limited upside than a an invested company where these investors are like, look, I can exponentially increase my value and I'll drag you along with me
Yeah,
and
but
you'll
those
be worth
ESOP companies
something.
aren't really looking to be multi-billion-dollar companies. They are looking to be a company that provides for their employees over the
Yeah,
course of their existence, right?
it's a very different piece. It's
Yeah.
more of a retirement program than it is a get rich quick scheme. It's a get rich slow scheme. Scheme being the British term for these kinds of plans, not
Thank you.
scheme like you're doing something evil like in the United States.
Mhm. Yeah.
Um, but if you look at all of those things and you say, look, really what they were trying to do is not give you ownership. What they were trying to do is make you feel and act like an owner because you got a piece of what the upside would be. It was
Hmm.
not uncommon in those days for people to exercise while they were still in a privately held company and hold on to the shares. So you invest and you're like, I would like to leave. I
Yeah,
want to
and
go
that
work at
basically
another
doesn't
company.
happen. That doesn't happen now very much, does it? Like very few
Almost
employees.
never.
Yeah.
Almost never.
But
Almost,
these were employees that believed in the value to the point that they were willing to put their own money out in front and buy the stock, which was
yeah,
illiquid. They can't do anything
yeah.
with that.
I'm
Yeah,
going
and
to
pay tax.
buy and all stock, and I'm going to
Yeah,
go work at another company. I'm going to hang on to the Amble stock. It's not worth anything to me right now, technically, because I can't do anything with it.
yeah,
But I'm going to hang on to it just in case I can do something with it. When it does go public, then I can sell it, but I bought it cheap, so it's fine. It's just an investment.
yeah, yeah.
No one thinks about that. There's so little upside
Hmm.
in option strategy to exercising early
Right.
unless you're going to do an 83B election, unless there's some reason you're. And so people just don't. And often people don't until they can't. And what I mean by that is if you wait too long to exercise, the tax burden at the time of exercise is so big
Yeah, yeah.
that you can't exercise anyways.
So in
Because,
many
yeah,
ways, if
you're
you
only
believe in
writing
the
a check.
company, you want to do it
Right.
early to get it at a low tax burden, because that's done then at that point. Then
Right,
until you
because
actually
you're
sell
writing
that
a
stock.
check for
Yeah,
$15,000 for your shares and $650,000 for the ordinary income that happens at the time of exercise.
and you mentioned an 83B in there as well. That's like a little area where you can defer that tax liability, right? You can incur
If
the
you
tax.
if you exercise prior to them being vested and you're willing to take the risk and you're willing to accept the fact that you might not ever get that money back, Yes, 83B elections are amazing. I think every company should allow people to exercise prior to vest, just as a general rule. But I think every company should also explain to people what the heck that actually means. Um, so the problem became equity changed from, hey, this is something that's worth being part of the organization and our mission, and we want you to stick around for a long time, to, hey, this is a way for you to hedge. And then if it doesn't work out 18 months from now, you can go somewhere else. And maybe you'll keep what you had. In a lot of companies, people are like, okay, I'll exercise my first vesting.
Yeah,
Doesn't cost me.
they'll take that first year, that cliff, the typical cliff after the first year,
Yep.
and
I'm going to
that'll be
save up
enough,
first
right?
year's worth of equity. I'll buy that. Then
Hmm.
I'm going to leave and get another and another and
Yeah.
another, because, as we were talking, before this started, um, the industry with the worst retention is not surprisingly fast food, fast casual restaurants. They have horrible turnover. They have horrible turnover because a lot of these people are part time. A lot of these people are working because they have to work here or there. They tend to be seasonal a lot of times. But surprisingly, tech is almost as bad when it comes to long term retention.
Yeah, I think it's about 2.5 years is the average tenure at this point, isn't it? It's one of the lowest in the Western world. Lower than I think, if I remember correctly, the BLS, I think is 4 years or so is the average retention across all industries, and tech
Yep.
manages to come in much lower than that. Yeah.
And if you look at tech startup,
Mhm.
it's like most companies, most HR people are going to tell you, look, if we can keep people for 18 to 24 months,
Mhm.
that's great. That's
Yeah,
retention.
right.
It's like, wait, so when you hire them, it's going to take you 3 to 6 months just to get them fully engaged.
Mhm, mhm.
Uh huh. Then you get 1 year of them. Uh huh.
Then
And
they
then
go.
they leave.
Yeah,
Uh
and
huh.
this happens all the time. Like, anecdotally, we hear this all the time, right? Like, the people
Right.
don't stay
But
very
you
long in startups.
for your vesting schedule with a 10-year life on that grant. Why did you just not give them a 2-year vesting schedule?
Well, I mean, let's talk about vesting schedules a bit, because vesting schedules were there really initially. First of all, they're a relic of pension funds. That's where the concept of vesting came from, right? And it was kind of inherited by stock. But it was there really to protect the cap table. It wasn't there to retain people. It was there to say, well, if you do go, then we're not going to pollute our cap table by someone that's just going to come and leave. So and a lot of people think of the vesting schedule as a means of retention. And to your point, it kind of is, but it's mostly about protecting the cap table, right? The vesting schedule and the
Well,
private.
it's a combination of protecting the cap table, um, and it was a way to allow for people to build up some time to invest in the company. And the reason it was 4 or 5 years is when all this really came to fruition in the mid early 90s, um, between 4 to 7 years was about your expected life as a startup. You were either going to go public or be acquired in that amount of time.
Yeah. And that's not
Not a
really the
lot of
case
companies
anymore, right?
survived out there for 10, 15, 20 years.
Which is happening now, like, which didn't happen before. Companies are staying private a long time, even VC-backed companies, which always surprises me, because someone's out there hoping to get a return on that investment. And it surprises me when you see these VC-backed companies that stay private for so long. I'm assuming someone's out there saying, hurry up and do something because I
But
need to make
but
some cash.
why? Why
Mm,
would they? So
yeah.
so once you're a publicly traded company, you have to prove things.
Hmm.
If you can take advantage of an IPO and say, look, we don't have to prove anything really. We just have to have an IPO at $500,000 million. So what's the chance that whoever's the fourth company on that top 10 list, what's the chance that their value at IPO will still be their value 4 years after IPO? Pretty low. I can't remember the percentage, but it's like 65% of companies within 4 years are worth less than they were at time of IPO.
Yeah, that checks. So that passes the sniff test. I feel like generally speaking, you see the IPO and then you see it just shrink down after that. And of course, if you're an employee of that company, you've got to wait 6 months typically, right? To actually access anyone really has got to wait 6 months. So you don't just get to go in at the IPO price and immediately sell out and take the cash. It doesn't work in a way. You have to
But
allow 6 months
VCs do.
sorry? Yeah.
Your
VCs do?
VCs
The
do.
VCs do, okay.
The
Yeah, so
VCs
they get out
exit
immediately.
out. They're
Yeah.
like, "Hey, we're gonna allow you to buy our shares
Mm. Yeah, and that's
at
part of that preferred
this
status,
level,"
right?
and they get out. They're done.
Yeah. Yeah. But as an employee, you've got to give the market 6 months to figure out if your company's worth as much as everyone thought it was and all those VCs thought it was at the time. So that's why you often see that drop off, right? It's actually getting a look under the hood and seeing if that company's worth all of
Yeah.
what it's supposed to be.
Whether the promises of a blue sky
Mm.
are really a blue sky. And again, all the filings are supposed to go around this, and the SEC is supposed to review it, and everybody's supposed to make it. But the reality is, it's hard to know. The
Hmm.
reality is, most companies don't do it very well. So for a VC to go, hey, look, we might as well market this as long as we can, because if we can get an exponential value out of one of our 20 investments, who the hell cares what happens to the other 19? If I get 5% of $500,000 million, I don't really care if I put in $1 million to 5 other companies. Who cares? It's $5 million down the drain for an uncountable number of millions on the upside.
Hmm. Yeah. And
And
do you,
so
go ahead.
the regulations around being a publicly traded company and the filings around being a publicly traded company and the scrutiny about being a publicly traded company and the media attention of being a publicly traded company are all much more difficult.
Hmm.
So why not stay private? Again, the reason companies went public was mainly because either they had too many shareholders in the days, that's why Facebook basically went public, or they need money. But we're in a day and age where public companies can get more money. But more importantly, we're in a day and age where private companies
Right. And you
don't
got
need,
private
oh,
equity sniffing around too.
yeah, you don't need to go public to get billions of extra dollars. I need 10 billion bucks. Somebody goes, all right, well, let's put together $10 billion and invest in name any of
Yeah. I think
15
a good recent example, I think, is EA, right? They got bought by private equity, which surprised me a little bit because private equity and gaming companies aren't normally a match made in heaven. But obviously, there was money to be had from a private equity fund there. Then probably at a certain point, would have been more likely to be found in the public markets. But you've got all these other sources of investment that can compete with the public market now, which I guess is part of the reason why these companies are staying private for longer.
Yeah. And so you add all that together. And I just think that we haven't evolved
Hmm.
how equity compensation should work, what it's intended to do, what it can do in a way that reflects what the marketplace is,
So let me
good
ask
or
you,
bad.
let me jump in there. That's a point you made earlier. So I want to ask you that. So what can companies do differently? Then, if we accept, I think you're absolutely right. The world's changed a lot since equity was first introduced. The legislation is essentially the same. Stock options are the same. RSUs are the same. Most things are the same. But the valuations of companies, the nature of whether they stay private or go public has changed. How should companies be doing things differently now to reflect that?
Well, I think we need to start with the concept of there has never been a one size fits all piece of clothing that's fit everybody. And we need to look at equity plans and go the one size fits all equity grant, not just plans themselves. Most plans look like every other plan.
But how you award that equity?
But even at the individual level, at the timing level, we need to stop saying that because I granted this many shares with this vesting schedule last year, I should grant a similar number of shares at a similar vesting schedule this year. You need to start going, hey, look, for this kind of a role, for this kind of a person, for this kind of a profile, for where we are in our time frame, for where we are in that ramp of prices, we should grant equity differently than we did a year ago or than we will a year from now. But people's argument has always been, but that's complicated. People won't understand it. To some extent, that's true, especially because nobody spends any money communicating anything or even really tries. But the comical part is we say that about equity plans, and then we give people like 82,000 funds that they can invest their 401k money.
All right.
Or we tell people, okay, so you need to sign up during open enrollment for your healthcare benefits. By the way, you literally have no idea what the hell half these things are, what they mean, what it's going to mean to you, but you have a week. Go through this thing. It's only 114 pages long with 97 different decisions you need to make. Go ahead and make all those, even though they're literally, in the case of options, it has to do with money. And this is life or death. So just make these life or death decisions.
But you do have things like target date funds and things like that. So if you don't want to get into all of that, you can just pick a fund that is kind
And
of
why
not.
don't we create the same kinds of things in equity plans?
So you think that maybe equity hasn't caught up in that maturity in the way that we can deliver
Nobody
it?
even tries to have equity catch up.
Hmm.
I don't think anybody really looks at equity and says, hey, we aren't doing this well.
So why
It's like,
is that? I mean, I think you're right. Like, again, it's like it's become so commonplace and so meaningless in many ways, and it's just table stakes for recruitment, and people just sort of brush past it. Also, by the way, one other point I'll make is there used to be a time when VC-backed companies paid less in cash. That's not as much the case anymore, right? For the most part, it's very comparable. So I guess, like, why even bother? Like, why do we dilute the cap table this much? Why not use equity more strategically and use it for people that actually care about it? And it brings me back to a discussion
because
that
that's
we had
harder.
once. Right, it's harder, and the idea that maybe we should be more flexible with equity in the same way we are with 401k matching, all that kind of thing. Is there room for offering
No,
candidates the
that's
option?
I think that's the biggest point is um first of all, it's harder. Most people in the comp world, most people in the HR world, most people that are in the executive world don't actually understand equity or the myriad of potentials that you can use it for and how you can change it. That's the first step.
Hmm.
Um, but I think even more than that is that people don't want to have one more complexity that they have to deal with, one more compliance issue that they have to deal with. So they just go, you know what? We're just going to grant the same thing to everybody. It's an imaginary number, anyways. It's like buying a lottery ticket. So great. Here's my numbers. Let the computer pick my numbers. I don't even care. If I win, I win. If I don't win, I don't win. And honestly, if it doesn't look like I'm going to win, if they start drawing the numbers and the first three numbers aren't mine, I know I'm not winning anyways. Just go get a job somewhere else, get a new lottery ticket.
Right. And there's also a weird inherent incentive to do what you just described because any investment advisor will say diversify your portfolio. And with the equity you get from your employer, you can't do it in a private company. You can't sell it and diversify it. So there's a weird kind of hidden incentive there to go to another VC backed company and get another set of dice that you can use. And maybe one of those two companies will go public. And there's another incentive to get a third company, because maybe one of those three companies will go public. And if you look at the odds of a company actually reaching IPO, it actually helps to have eggs in lots of different baskets, right?
Oh, the interesting thing is I oddly, because of the industry that I'm in, I've talked to a lot of billionaires in my life, way more than I ever thought I would when I was, a teenager. And of course, then there were only like 10 on the planet. So it's much more rare occurrence, but I've talked to a lot. But I had one explain it to me this way. You become incredibly wealthy because of one investment. You stay incredibly wealthy because you diversified. You don't become incredibly wealthy by diversifying. You stay wealthy. So if you don't have money, one stock is a great way to go if you pick the right one. And then people think you're a genius. 'Cause look at the thing, you did that thing. And it's like, well, really, was that software engineer at that company that happened to go public any better than that one that or the company that didn't go public. No, nope, definitely not. They're the same. They twins. You could do an identical twin study like they do in so many other things and go, oh yeah, literally no impact. Um, but we don't take the time to offer multiple, like, we should give people not just a choice between cash and equity, but do you want a 2-year vest with this many shares or a 5-year vest with this many shares, these kinds of restrictions, this kind of upside, this kind of performance criteria, or this one, which is really just designed to keep you for the next 18 months. It's not very much, but it guarantees you can exercise it whenever you want to, and it'll stay alive for 6 months after you leave. This one stays alive for 5 years after you leave, but you got to stay for 5 years to get it.
So you're letting employees kind of choose based on their risk profile and what they're looking to get out of their employment. But to your point earlier, though, people already don't really get it. Isn't this just going to make it even more confusing? They
As
having
long,
all this option.
as, long as we're willing to live in a world where we don't communicate, where we don't educate, yeah. My argument is people should be spending more money on communication and education. People should understand these tools. I have a basic rule on communication for comp, which is companies should budget 1% of the value of their compensation in communication.
How many companies do you think meet that, and how many companies?
Almost zero.
Yeah,
But
and when you say,
imagine if
yeah,
you have a total value in your equity plan plus your base pay over the next 5 years, you do a cumulative of your base pay and your projected value of your equity, and it's $1 billion. And you only spend 1% of $1 billion on communication because it's 75% of our expenses, 65%
yeah,
of our company's
and
expenses.
yeah, we're talking about big numbers here, right?
A
On the
ridiculous
P&L.
investment we're spending. And
Yeah,
I'm going to spend 1% of that total investment on communication.
and what would you spend it on? Like, where would those dollars go if you're trying to improve communication?
One, I would spend it on far more accessibility to have somebody internally that knows what the hell they're talking about, explaining to people all the time, not when they
Hmm.
get around to it twice a year.
Right. So
It's like,
ongoing access to people that understand what it's about. Okay.
yep, way better tools for communicating things, allowing people to do projections, way better support from tax professionals.
Hmm.
They'll
Hmm.
spend money from tax and investment professionals to let them come in and let them and make it almost mandatory for people that you get educated. If you want to get your equity or you want to keep your equity, you have to be educated in your equity. So
Yeah.
you know you're valuing it.
I kind of think it's like, that clause when you invest and it says stocks may go up as well as down and all that
Yes.
kind of, we don't really give that same warning to employees when we give them the equity. It's kind of assume that because you're an adult, you understand it already. It almost needs to come with that same level of warning and, like you say, mandatory education. You're giving someone a risky financial vehicle. That's what it is. It's by design. It's a risky thing to do. So I totally agree. Like it should be just
So
a given
I
that you
think
get
we're
that.
getting close to the end here. So I want to
Yeah.
just bring this up on this communication piece. I was talking to the entrepreneur in residence at one of the Sandhill VCs several years ago. Smart guy, understood equity, well connected. And we were in talking about communication. And one of the partners at the VC firm walked by and said, "What are you guys talking about?" He said, "Communication and people should understand their equity better." And he goes, "Why would we want that?" I was like, "Okay, give me your opinion." He goes, "If we communicated the value of equity, then people would know they weren't going to become millionaires. And why would we want that?" And then walked away. It was one of my shortest conversations of insanity. But I was like, that is like, yeah, don't tell people that this is all fake. Don't tell anybody. And I was like, wow, that is so insane. And also absolutely believable.
It is kind of believable, isn't it? I've weirdly haven't got an immediate counter argument to that because the mystique of equity is part of the value of it. And if you start letting people peer behind the curtain, then you could have problems if you start trying to reconcile the financials with the supposed value of the equity you're giving people.
Well, again, it was the company I talked about, their common stock at their supposed successful IPO value, their common stock would be worth negative 74 cents a share. And I'm like, I went, first of all, how do you guys think that's a successful IPO? Because you know everything you get is going to turn into common stock, right? What do you mean? All your preferred stock that you got, you're not the investors. Everything you own is going to be common stock after this happens. And when people see all the financials, your common stock is going to be worth nothing. So everything you have is valueless after the IPO.
But all the VCs would have already gotten out at the time of
Yeah,
IPO. They'll
they
all
will
be up
all have
in the
left.
mountains in their villas right now.
And so the executive team at that company went, well, then we're going to change our program so we can exit out at the same time as the VCs. I went, that's fraud. So you're going to find that difficult. I said, I have to stop being your consultant now. I literally fired a client but I was like, it was insane.
mm,
It
mm.
was absolutely insane. Of course, the IPO never happened. It all fell apart because, as it turns out, some of the outside investors went, wait, you're going to do what at home? That doesn't, you're going to take all the money out of the company on day one and what's left? What do you mean? So that's the other side is there needs to be better disclosure.
I certainly agree with that. Like again, like everyone assumes stock is stock, but this idea of the word preferred is the warning that everyone should heed, I think, because there is someone out there that has preferential voting rights, decision rights, value rights, and is going to do things before you can. And again, it speaks to the idea that it's kind of a shame. Like we talked about the ESOP movement, which, and Louis Kelso was the pioneer of this, and he had this wonderful philosophy that it's not about capital is not the problem here. The problem is that the people that generate the value do not become owners of that value. And that's where the ESOP movement all came about. And the problem, I think,
Corey
is,
Rosen's a good friend of mine. So
oh, really? No, I don't know.
he wrote a lot of that
Oh,
actual.
really?
Yeah.
Oh, okay. All right. You have to refer me some reading materials then after this, and I'll have to dig into it. I find that all really interesting. Um, but I think that's the problem with the VC-backed companies is that you are given equity, but you're not making owners. So you're not really getting a say in how the companies run, and that's what Louis Kelso was talking about, and Laurie Rosen by the sounds of it as well. But then the flip side, then you don't get that hockey stick valuation because if you own the company, you want to retain the company and you want the company to keep doing what it's doing. You don't want to push up the value and then sell it off a few years later. So it changes the objective of that company, I think.
Yeah. It's a frustrating place to be as long as people aren't going to be honest.
Hmm.
And the reality is the honest opinion of equity is that we haven't been using it the way it was intended to be used for a
Right.
very long time.
Right. Yeah.
It doesn't deliver the results we claim it delivers and hasn't for a very long time. But if you talk to compensation people and HR people, you say, what's the reason you have equity? Well, we want everyone to feel and act like owners.
Right.
And it's a great retention program. Well,
Yeah.
I'm like, well, no one feels like an owner and you're not retaining anybody.
Right. Exactly. Yeah.
I'm not
Yeah.
saying equity's bad. I'm
Hmm.
saying everything we do with it is
Hmm.
bad. It's sort of like, you know, people will complain, well, beef is bad or sugar is bad or no, none of those things are bad used correctly.
How we use it. Yeah. Yeah.
But yeah, if you only eat beef all day long, that's the only meal, you're going to die earlier than somebody that doesn't. And if you use equity believing it does things it can't, you shouldn't be surprised when it doesn't work.
I think that's an excellent point to conclude on. And for the benefit of anyone listening, so you're on LinkedIn, by the way, Dan. So if anyone wants to follow you, you're on LinkedIn. I see you on panels all the time. I assume you
Yep,
have your own website and things that you can people can
I
get access.
do. But again, the easiest way to find me right now is LinkedIn. I've been on LinkedIn for a very long time. So it's literally like linkedin.com/n/Dan Walter.
Nice.
So
Okay, well, this has been fascinating. We'll have to pick this up at some point in the future as well. I still feel there's more to discuss around this, but I want to thank you very much for your time, Dan, and we'll do it again soon.
fantastic. Thanks very much.
Okay.
All right. Talk to you soon.
All right. Take care.
All right. Bye bye.